Hey guys, we're here for our next panel. We have Mona, Ben, and June, and they'll introduce themselves in a bit, but the talk is going to be around DeFi, CeFi, and market makers, and I will let them take it from here.
Great, I think she said go.
Great, so should we just kick off with some intros?
Sure, June, could you hear?
Yes. Let me shepherd the process. So we have on the far left of the screen Mona El Isa, who is currently riding out the pandemic in Switzerland. Mona co-founded Melon Protocol, and before that had a longer in the traditional financial markets, as well as at Goldman Sachs. Mona, do you have anything to add to that intro right now?
No, not really. That's a great intro. I mean, I would just say that my role at Goldman was making markets in equities, liquid and illiquid. So I guess that's the context being brought here, because Melon obviously is not a market maker, but it's an asset management protocol.
Mm-hmm. Exactly. Yeah, that would be really relevant to our discussion. And then next up is Ben Chan, who is the CTO at Bitgo. Ben is from Singapore, and I think he's currently in Singapore, even though he is usually based in the Bay Area. And you want to add a couple of lines to that, Ben? What are you working on? What's catching your interest right now?
Hey, are you there?
Your image is frozen, but I hear you.
Same.
Hey, can you hear me?
Yeah, it's a little bit patchy.
I'm here.
Yeah, we hear and see you now.
Okay, I think we're good. Oh yeah, great, thanks. I couldn't hear 100% of that, but so thanks for the introduction. So Bitgo is a digital asset financial services company. We were the first regulated custodian purpose-built for digital assets, and we've been around since 2013. We're known for our blockchain security and scalability platform, which powers about 15% of global Bitcoin transaction volume. And I guess the interesting thing with us is that we delivered, we've been straddling both the CeFi and the DeFi worlds over the years. We've delivered, trusted products like custody, settlement, and lending. And on the DeFi side, we've, contributed towards wrapped Bitcoin, which has enabled trading, lending, and the usage of Bitcoin through the Ethereum DeFi ecosystem. And so, I think it's super exciting to be looking at both these worlds today.
Wonderful. Just two really great panelists. Just now in the green room, I was, struggling to keep up with their patter about the intricacies of the financial world. I'm June Ian Wong. I'm a managing director at Coindesk. My main job is to put together the Consensus Conference. I started the Consensus Conference back in 2015 and was an early employee of Coindesk, covering the space since the halcyon days of 2013 when a Bitcoin was, $20. But here we are now talking about decentralized finance. So our topic is all about this question of settlement. And sort of the speed of settlement. And I think most people understand this question with this framing, right? Which is the more decentralized you are, the slower the settlement. And slower settlement is not something we want. Now, who wants to go first at sort of coloring in the lines of that framing and like putting in some of the subtleties that you both have been talking about here?
Mona, what would you say settlement is defined as in the DeFi world?
Yeah, so I mean, same, I guess. Well, maybe not the same actually, given our previous conversation. But I guess I guess for me, so I guess the topic of the talk is market making and settlements, and is faster settlement kind of the limitation when it comes to market making? And so I guess my view, whether it's centralized or decentralized, is that my view is settlement is not the issue. I see settlement, not being the factor that holds us back in terms of liquidity. Whether I know some people define settlement as differently. For me, it's really just the settlement time it takes for a trade to reach the counterparty, right? And the reason I don't think it's a settlement issue or a time issue is because we have T+2 or T+3 settlement in most traditional financial securities, equities, bonds, whatever. But we don't see a liquidity problem in many of those assets. So I don't see it as the main limitation. I see other things as limitations, but not the speed. So I think I'll just hand over to you, because I know you have some views on that as well.
Well, I think there's many different factors that should be taken into consideration into how much liquidity can be provided in a market. I do feel like there is a difference between centralized finance, market making in centralized finance and decentralized finance, in the sense that you can have T+2 settlement in when settling up a trade in traditional finance, and not essentially like tie up too much capital during that time. But in the DeFi environment, because you want to have something, you essentially want to be trustless. Essentially, whenever you're putting up a trade, you need to put up, in many cases, 100% of collateral, right? And so that collateral is going to be essentially placed there until the trade can be settled. And so the collateral requirements in DeFi are a little bit higher, or probably higher than centralized finance. And that might impact the amount of capital that you need in order to make large volumes on the market.
Yeah, so I agree with that. And I guess that just goes back to my point that I don't think it's just a speed issue, but I think balance sheet, as always with market making, plays a very large role in providing liquidity. Obviously, on-chain, it's, there's pros and cons in terms of the ability to market make. But I think very much so that you still need the balance sheet, and you still need to be able to ideally leverage that balance sheet, because you're in the business of providing liquidity at the point where assets become illiquid, and therefore you're going to inherit positions you don't necessarily want, and that can be very volatile. So I think that's probably the biggest restriction or limitation in terms of DeFi right now, that I'm not sure that market making at its core is really understood, and I'm not sure that the balance sheet availability is there in order to provide the liquidity.
So if I can try and just reframe that or rephrase that, Mona. So you're saying really the bottleneck here is not the speed of on-chain settlement, but it's these issues with collateral requirements in DeFi, which is the thing that you agree with Ben on, right? So if that's the case, do we see a way forward here? How do we get to sort of under collateralized sort of situations in DeFi? Are there projects that you're observing that are able to offer this and get this bottleneck out of the way?
So at this point, no, I don't see any projects in DeFi that are able to scale liquidity. I see projects that are providing some forms of liquidity, but they sort of only work to a point where an asset is liquid. So they deal with high touch, low size. But at the point where an order is big enough that it becomes illiquid, that is when the market maker is meant to step in. we're still not able to deal with that efficiently in DeFi. Ben, maybe you can comment more on the CeFi side of things. From your perspective, I think you're closer to that.
I mean, we're watching both of them, quite intently. I think it's true that the amount of liquidity in DeFi, or rather, to put it another way, the size of the order that you can fill, if you were to try and make a trade of, say, from WBTC to DAI or something like that, the maximum amount of size without moving the market in DeFi, is not a lot, right? Like if you try and sell more than 50 or 100 BTC on a DEX, on Uniswap, you probably move the price quite substantially. And I guess that's where it could be interesting to think about who's on the other side of that trade, right? And maybe it's not like a market maker by definition, but if you actually slow that down a little bit, let's say we had really quick on-chain transaction speeds, right? Like let's say every trade could be made on-chain within a fraction of a second. Then you could make a trade, let's say, you were making a trade selling ETH for DAI, right? Like ETH is 210 or whatever it is now. You make a trade, it goes down to 209. Immediately someone else on the other side could come on and take advantage of this cheaper price to buy the ETH back up to 210. And then you could sell again at 210 and let it go to 209. And so over a short amount of time, you would be able to get your 100 ETH sold, right? Whereas if you try to fill all of that today, because it would take time for people to notice these trades on chain and come on to place their orders on chain, then you might have more slippage, right?
You definitely will have more slippage for sure. But I think that there's sometimes a misunderstanding or a misconception between kind of arbitraging between exchange. And we talked a little bit earlier about the fragmentation. That maybe the restriction in CeFi is more of a fragmentation issue rather than a settlement issue. It's obviously hard to move around from different accounts and manage your balance sheet. It's not because it's not all held in one place. So that is a massive restriction. Again, I think I would weight that higher of a limitation or a restriction than I would the speed of the settlement, because a lot of the kind of trading you're talking about is happening on the order book, and I'm talking about the type of trades which are market making trades, which do not necessarily happen on the order book. In fact, most market making or real market making happens off the order book, and it happens settles OTC, and that's the stuff that I think really we really need to talk about if we want to talk about liquidity and scaling it.
Yeah, I mean, Bitgo actually does offer our settlement product to several OTC providers today, as it is already, and it is being used to settle up between for trades between counterparties, for example, with OTCs to small funds that want to buy a sizable amount of coin that would otherwise impact the market a little bit. So I think this fragmentation problem is definitely very real. There's no single location or single venue where everyone is trading at today, right? And so in order to trade on all venues, you end up having to split up your balance sheet. And this is not very ideal because when you want to take advantage of an opportunity at one of these venues, you can only take as much opportunity as you have funds in that particular venue. And then you're limited by somewhat the speed of which you can get more funds to that venue again, which, I think the purpose of this is not really to make an argument for whether it's settlement or not called settlement or whatever it is, but the limitation of that is how quickly you can move the funds in there to take advantage of that opportunity. and like, yeah, make the spread thinner.
Yeah, so I'm just seeing some comments coming through from Al Ostfan and Ellie Henry, so I'm just going to comment on them. So, so basically, it's they're saying that this doesn't sound to be a DeFi versus CeFi issue, but rather an order book versus automated market maker issue, and that AMMs, in some sense, are OTC. The liquidity providers take the opposite side of your trade. So yes, I am totally aware of that. I know the difference between order books and market makers. What I'm trying to say is actually not, there's no liquidity in. So I understand that automated market makers provide some liquidity, but all I'm saying is that they're only able to deal with very small size, because at the point when you get above a certain size, the price becomes uncompetitive. And a market maker should always be providing more competitive prices than what an order book can provide. Otherwise, frankly, it's not really an automated market. It's not really a market maker, because it's not providing liquidity in illiquid situations. That's just like the pure definition of a market maker. So there are alternatives to automated market makers, and they're manual market makers. They're still decentralized. Like Kyber, for example, has a great infrastructure for plugging in a manual market maker or a custom market maker. And I believe that these can, the manual market makers can scale, right, in a completely decentralized, in a decentralized way. They just can't do it autonomously. So I guess for me, just let's clarify that point straight away.
So I had a question which I raised with both of you earlier a little bit. So at what point do we think that on-chain scalability starts to become the bottleneck for things like settlement? So, Mona, you said earlier that's not the current bottleneck, but do you think we'll reach a point at which that does start to become an issue? How urgent is it basically? How much do we need scalability on the base layer to, not have to worry about that being the bottleneck?
So I think it can help order book liquidity on chain. Scalability can definitely help with that. And Al has correctly said again that market makers are not incentivized to provide liquidity in crypto in illiquid situations, and that is correct. Because there's the risk of front running, or somebody coming along and market moving against you, and you not being able to cancel your order fast enough because somebody increases the gas price to some maximum amount to cancel your order, or to hit your order or lift your order before you manage to cancel it. And so that is a limitation, right? And that's probably why the manual market makers in DeFi are probably not making bigger size. But there are ways around it, right? They're just kind of more, they're sort of less technological, they're less autonomous, they're less automated, and they're more manual. So that would be my comment, that scalability will help, of course, on order book liquidity, but I don't think that it's going to change or move the needle massively for the manual market making and the OTC. And I think that's ultimately what is going to drive liquidity in DeFi.
Interesting. Yeah, I mean, if you look at it another way, in terms of anything that you have to do where the relationship between when the capital moves and when the trade moves are tied together, and you're tying up some kind of capital before the trade gets executed, I do believe having transactions moving quicker. However, there are other methods even in a decentralized manner, right? So you could, if you had a way for everyone to agree on a common standard vault or protocol to lock up all the assets, and then have trading happen, even in a committed way off chain, in trustless way off chain, and then settle up later on. In other words, deferring the settlement action to be at a different time from when the trade happened, then in theory you you are mitigating some of these delays.
Mm-hmm. We're into our Q&A sort of portion of the program now. So guys, put your questions in the Ask a Question tab, but I'm going to grab questions from this chat stream over here. So Nathan Baredes asks, do on-chain order books like Oasis make sense in the long term?
Do order books like Oasis make sense? Is that the
Do
question?
on-chain order books like Oasis make sense in the long term?
Yeah, I think so. I'm not, again, that's maybe something I'm not sure can scale without, oh, did we lose Ben? Yeah, that's something I'm not sure can scale. But yeah, they do make sense, yeah.
You want to jump in on that, Ben, or we have a couple more questions as well.
Let's take the next one. I think that one's answered.
Okay. Here's a nice one with 2 upvotes. How do market making strategies differ with liquid versus illiquid assets?
That's a really great question.
That's great.
Yeah. So, well, the thing is, like, market makers by definition are supposed to provide liquidity for illiquid assets, right, or for illiquid trades. So you don't really need them when an asset is already liquid. So if you can already buy the quantity you want to buy on an order book, you don't need a market maker, and vice versa. If you want to sell, So if you can, essentially when something is liquid, you don't need a market maker. You need a market maker when somebody wants to buy 10% of the total supply on the spot and doesn't have the patience to wait around and work an order. And that's where a market maker comes in. So how do market making strategies differ between liquid and liquid assets? Well, in my opinion, there's no problem right now with liquid assets, and so you don't need a market maker. Like, order books solve that, and to some degrees, and AMM solve that really well. But illiquid assets is where market makers need to come in and provide take in lots of different inputs. They're going to inherit a position by making you that price that they don't necessarily want that position. They're going to have to make you that price, and they're going to have to unwind that risk and suffer the consequences, or maybe sometimes make a profit. But in general, market making is a very hard thing to do. You need a lot of balance sheet. And in terms of strategies, I'm gonna deep dive into that in my next talk, which is straight after this. But I think it would probably take up too much time if I do all of that right now.
Give us like one highlight before your talk, one preview.
So like a market making strategy. Okay, so for example, one input that you would take into account is what has the price. Okay, so I know there's been some discussion about this in DeFi right now, but so far I haven't seen anyone implement this. But you might take into consideration the current or last price and why something has moved, or you might also take into account why it's moved, and whether, if something just dumps 40%, if a token dumps 40%, and then someone comes and asks you for an offer in huge size, do you really want to get short at that level? Like, probably not. So you're going to have to skew your price in a way that you're comfortable with that risk, but in a way that also the trade happens. So you're not pricing it so badly that you miss the trade, because the whole point of your existence as a market maker is to create the liquidity.
And that can be quite difficult to automate. I think when people talk about the current automated market makers in a DeFi sense, they talk about it in terms of offering a small amount of liquidity at what people would consider a reasonable price. And I think that there is some value in that, for sure, especially for very, very illiquid tokens and getting those pools bootstrapped. I think that's what really, to me, is really innovative about the automated market maker like innovation that we've seen recently. That you can start with a small pool, many other people can add to the pool, and that does add to some extent a bit of liquidity at a decent, without too bad a slippage. I think for large amounts, like 10% of the total amount of that token, you're still, you still have to pretty much do this manually.
Yeah, I mean, I would say like actually from 2% of the total pool size onwards, you start to get really uncompetitive prices. So it's even more than that. So what it means is it's not like they serve a purpose. AMMs serve a purpose, but they won't help scale liquidity, in my opinion.
So guys, once again,
exactly.
Definitely pop your questions into the Q&A list. We've got one more question here from Yusuf. Can we imagine an on-chain clearing platform in the near future?
Yeah, well, I mean, I'm going to take that as a platform where you have a single smart contract that does clearance for multiple trades from where maybe multiple dexes or places that may be on chain or off chain, but that are trying to execute settlement. And I think that that's an opportunity which people have been thinking about and discussing. It may be a little bit early in terms of the need for such a platform, in my opinion. But at the same time, because it is a standard, it can't be too early to build one, because it takes a lot of time to get multiple parties to use this protocol together.
So I'm not entirely sure we need it in on-chain as much as we need it off-chain, because of the problem that we started off speaking about, that there seems to be much more fragmentation off-chain, just because of all the different restrictions that different exchanges put on. So I think to answer the question, yeah, I guess we could imagine a clearing platform, but I'm not sure that there is a huge need for it. I think there's probably a bigger need for it off-chain.
I think the use of it in the
OTC players. Are there efforts among OTC players to set up a clearinghouse or a framework or something that gets them all more coordinated and could solve some of those issues?
I'm not aware of any. Maybe Ben, you have, not aware of any.
I think many OTC players and clearing, many OTC players would be interested in using something like this because it does reduce their counterparty risk, but they're also very wary about leaving funds in a smart contract, not so much just for the security reasons, but because that essentially ties up capital. And so what I feel like how I feel something like this would work is you would place some capital there, which would be ready to trade, and you could trade off-chain. We could exchange signatures over a trade. Say, me and June, we make a trade. We create a signed message saying we agree to trade this amount of ETH for this amount of DAI, and then later on we could use the on-chain contract to settle that up. So that could be very useful to aggregate multiple, trades together. It would need to be, sequenced and so on. But that could be something that is useful to have. And I haven't heard about anyone that's been working on it just yet, though.
Yeah, you were going to say something before I ask my question. We have like 50 seconds.
I think that's what I wanted to say. But
okay, well, we have one more question, which I'm not sure I fully understand. OTC is the way to go with virtual assets. Would be the way to go with virtual assets.
Well, what are virtual assets? You mean crypto assets?
Carlos, if you want to clarify, you can. We have like 20 seconds left here, and I think we lost Mona as well.
Yeah, I think she's getting ready for her next talk, and that's fine. Well, I think it really depends on how
Carlos says
much you want to
Tezos.
trade.
As an example,
Tezos.
Tezos.
Well, it depends on if there are liquid exchanges and a liquid market today, right? Like, so if there's not many exchanges with a deep order book for Tezos today, and you wanted to trade a large amount of Tezos, then you'd go and ask someone over the counter to make that trade for you. And that's really what OTC is. And there's many OTC desks that do that at scale and at very large amounts of volume, giving you a better price than if you were to just buy it all in a very illiquid order book today. So it depends on the amount and how liquid the market is.
Sinju, are we running out of time or should we keep going here? It looks like we're at the
I think you guys can take one more question.
Okay.
If you hear her, Ben, let me know.
She said we can take one more question.
We can take one more. Well, guys, do you have a question? If not, I kind of have a question.
Well, why not ask it while we wait?
Yeah. Okay, I don't see anything coming up. So my question is, so I've seen a lot of commentary around the Black Thursday thing, right? And the sort of the problem. I think the conclusion of much of this commentary was that, the problem is base layer scalability, right? Everything was congested, and so transactions not going through and exacerbating everything. So is that, I guess, in your view, an accurate assessment of what happened in Black Thursday? Is really the ultimate bottleneck base layer scalability again, allowing things like moving funds in and out of CDPs and moving in out of exchanges to happen?
Well, yes and no, right? If you have unlimited scalability, then suddenly it becomes a number of these challenging problems get solved. But at some point, you're always going to hit a limit to the number of transactions that you can process in a certain amount of time. And I think I would say it takes, a lot of extra effort in order to think about what would happen in those situations where you have both a very challenging on-chain environment as well as, a very exciting or like highly volatile off-chain price environment that is moving very quickly. And that it basically involves design and responding and getting mature to having dealt with these problems before. So you could think about it. At least I think about it as if you could only send out video at 10 frames per second as opposed to 60 or 30 frames per second, right? You would have not great video, but you could do certain things to make the video still pretty enjoyable to watch. And I think that's what many of these, dApps are doing today, and that they need to do to kind of take a look at how can you look at all the possibilities of what could happen in a short amount of time and account for them and make sure that your application is behaving in a way that is somewhat expected.
All right, cool.
I love that analogy. It's like low-res video on the internet.
Right.
Maybe back in the early 2000s.
All right, this has been great. Thank you guys so much. I'm going to kick it off now.